So we summarize it and put it together, 7 criteria to help you guys, help real estate investors in general to decide.
Hey investors, Bradley here from Watson Estates, and you're listening to the largest, fastest growing podcast for Toronto real estate on iTunes, Spotify, and Google Podcasts. If there's a question that I get more than any other question, it is, have you spoken to a guest that can educate me, teach me whether I should incorporate or whether I should be buying a property in my own name? So today we have Cherry Chan on our show. She is an accountant. She's an author, a blogger, an entrepreneur, and a mom of young children. She puts out fantastic tax tips. In fact, her website is called realestatetextips.ca. And she is a best-selling author on Amazon, a book called Complete Taxation Guide to Canadian Real Estate Investing. Well, we chatted today about her 7 steps, 7 important considerations if you're thinking about either incorporating or buying in your name, things to think about. Very good conversation, a good introduction if this is a question that you've been having, or even if you've been doing for a while, a good refresher. If you have any questions for myself or for Cherry, you can leave them in the comments below. Please support the channel. Please hit that like button. We try and get topics out there that people are asking about, and this is absolutely one of them. I know you guys are going to love this episode. Enjoy the show. Cherry, how you doing?
Hi, Bradley. How are you?
I'm good. Thank you for taking time to come join us over on Toronto's #1 real estate podcast. I'm excited to hear from one of the top accountants in our area. So yeah, maybe you can introduce yourself to our audience. Tell us the life of Cherry. Tell us a little bit about you.
Thank you so much for having me on. It's an honor to be invited to the Toronto #1 real estate show. So I am very honored. Thank you. I am Cherry. My name is Cherry. I own an accounting practice that focuses primarily serving real estate investors and real estate agents. I guess I started off at being a real estate investor, learning about refinancing, starting refinancing my own home, buying investment properties, and that is how it got inspired to do more research in the real estate arena, taxation and structure, because I'm an accountant by trade, and that's how I started looking into it. And then I realized there is nothing out there, so I started my accounting practice, sharing what I've learned. Today we are a firm of about 15 people, 15 employees, and servicing a lot of real estate investors out there.
Yeah, no, I agree. There's not a lot of resources available. I mean, you've got this general consensus among realtors, please check with your accountant. I do it too. I'm guilty of it, where it's like, please go talk to your accountant. But there's a bit of an ignorance that there's not a lot of folks out there that specialize in investors and working with investors in the real estate field. So that's why we're excited to have you specifically, because that's precisely what we want to talk about. We want to be able to introduce someone who maybe has a couple properties but wants to scale and is trying to decide on how to build and structure that portfolio. So the $1 million question that I get asked all the time, right? And they always say, do you have a podcast where someone is talking about this topic? So just by responding to this topic, we're going to be referencing this episode a lot. Whether or not investors should incorporate or buy properties in their name, how do you distinguish what's the right path for an individual?
It is such an individualized decision to be made. There is cost associated with setting up corporation, and that inherently deter a lot of people setting up the corporation. So I would summarize, because that is also the #1 questions that we get as an accounting firm. So we summarize it and put it together, 7 criteria to help you guys, help real estate investors in general to decide. Now, I'm just going to repeat my 7 questions, 7 considerations here, but you can always download my free report on my website. Now, the #1 thing is, what are your investment strategy? Now, investment strategies matter. For example, as of right now, if you do, some people like to venture out of their long-term buy and hold situation and started doing flips. And if they do some wholesaling, I'm sure you know some people that are doing wholesaling deals, off the market deal. If you do also building infill development, you buy a lot and then tear down the whole old house, or just sever the lot because the lot is huge and build 2 more houses on it. That's called building your own home, and you sell it immediately after. Building a property and sell it immediately after. Those are strategies that are being used by a lot of real estate investors out there, and they are typically considered income. What is income versus capital gain? Income is 100% taxable. Your employment income is income, 100% taxable. Your business income is income. You can deduct your expenses, but it's still 100% taxable. Rental income is an income, 100% taxable, so as property management fee. So those are common categories of income, examples of income. Now, capital gain is different. Capital gain is the gain that you make by investing in some vehicle. It could be a property or stock long term, and then eventually you sell it and you make a profit. So for example, basically anything that's under the category of long-term buy and hold would be considered the long-term investment, capital investment in the eyes of CRA, in the eyes of Income Tax Act. And so when you sell property that's long-term buy and hold, and eventually you sell it, realize a profit of like say 100,000. If it is considered capital gain, then only 50% of it is taxable. I mean, this number could go up depending on who got elected in the upcoming federal election. But right now, as of now, it's only 50% taxable. So based on that, if you make $100,000 of capital gain, 50% is taxable. But if you make 100% of $100,000 of income, which from flips and or from wholesaling, that 100%, that $100,000 is taxable. So 100,000 taxable under income, $50,000 taxable as capital gain. Depending on your particular situation, typically for people who are using strategies that are earning income, we advise them to set up a corporation, because in the corporation, these sales would be 100% taxable, but it's only taxed as low as 12.2% in Ontario. Whereas capital gain, the decision factor is not as simple. It takes a little bit more to decide whether you should set up a corporation or not. So that's the number one factor. Did I lose
That's great.
you yet?
Yeah. So I love that. So to really simplify, I think I appreciate your detail there. I think that's going to help a lot of people. If you're looking to generate primarily income, the income total is going to be highest, best to do it in the corporation. And then obviously having it coming to you personally would matter if maybe you don't claim much other income. Maybe there's a bit of an advantage to doing it there, but generally income you want corporate for the tax rate. Love that. Cool.
Yeah, so that's the number one reason. Number two reason is how many properties you're planning to buy, right? Like if for investors out there, they are thinking of, okay, I'm only going to buy one property, and that property could be Mississauga condo or downtown Toronto condo, which is very simple, very straightforward. And that's all they are going to plan to buy, or maybe one more condo. And to them, those are their retirement fund. And you don't necessarily, if you have the mortgage qualification ready, you don't, like, the risk is small. And if you set up a corporation, the cost to set up a corporation is anywhere like $2,500 is easy to incur. And then annually, you also have to pay like a couple $1,000s to file the tax return. If you're only owning one condo unit in your corporation, it is a lot of cost to take care of, unless there are other reasons for you to set up a corporation. Now, on the other hand, if that one property is a plaza, that's like 150,000 square feet plaza, that you have like 10 tenants, all commercial tenants, that's a different story as well, right? Like you want to set up a corporation because who knows who's going to claim slip and fall on your property in the parking lot during wintertime. So the number of properties and the nature of the properties, like the nature of your investment matters as well. But typically with one residential home or one residential condo, we typically do not advise our client to set up the corporation and so that's the reason why we sometimes don't tell our client to set up corporation.
So based on scale, one of the other things you mentioned was a slip and fall, and I'm sure this might come up later too, but yeah. I'm curious, can you overcome that liability you have personally with insurance, or is it not a true coverage? Is there no way to truly protect yourself apart from a corporation?
So then that brings us to the number 3 criteria, right?
Perfect.
So that's a legal protection. How much do you want to have in terms of insurance coverage? How much protection do you want to have in relation to what you own personally? So I once had a consultation with a lady who's in Burlington. She just inherited like $500,000 from her mom who passed away. And she also has a payoff home in Burlington, nice home, probably worth $2 million right now. And at the time, she also had a RSP, a huge pension waiting for her. And so she's considering taking the inheritance that she has, which is the $500,000, was the $500,000 to invest in student rental. Now, if you don't set up a corporation, there's no layer of protection.
Yeah.
Because corporation is considered a separate legal entity. It can be sued and sue other people and be sued by other people on its own without the I guess putting the personal asset that the shareholder owns in their personal name at risk. So if you were her, she's thinking about setting up she's thinking about investing in a student rental. Would you set up a corporation? I personally would set up a corporation because of how much she owns in her personal name. Now, to answer your question, how likely would a normal insurance policy be able to cover that potential liability? It's hard to say. I'm not in the business of insurance, and it's probably easier for I would say when I go through the insurance claim, I've gone through probably 3 over the last 10 years, 3 insurance claims. The first thing that they do is to look at their list of items and see if they can get out first. So you know how like they look at the insurance policy and they
like the insurance company's trying to avoid coverage.
Well, like those are the terms and conditions that we all sign up for. That's
Gotcha.
what they're trying to get it.
So it's not a true match. It's not a direct comparable to having corporation. That's pretty much the short of that answer. People can look at the terms and details of the insurance deeper if they want, but I think that that's pretty straightforward, that there's no better way to protect than corporation. So.
It's not 100% protection as well, right?
Yeah.
It's like insurance on another insurance. You have the property insurance to cover your specific property, but at the same time, you have another ownership there to protect, essentially to increase another layer of have another layer of protection.
Gotcha. Okay.
Mm-hmm.
So I think that's helpful. So obviously the insurance versus corporation is your better route. Yeah. So the amount of, so far, I guess to summarize it, we've got how active are you? Is it income? We've got the scale of your portfolio you've talked about. And good. Okay, let's keep going.
So we have the legal protection as well. And then the fourth thing is how much you are already earning in your personal name. So it matters. The reason is because as an example, one of my clients who own 5 properties, he owns everything in his own name. He basically lives off the rental income. And he is not, he's a full-time real estate investor, but he also doesn't earn any other income. So rental income is the only income that he reports on his personal name. Now, because of that, he doesn't have a salary, $50,000, $100,000, or even $150,000 to report first. So every year, his annual income is ranging anywhere between like $30,000 to $50,000. Now, in the corporation, to report the rental income, the corporation rental income is considered passive income. The proper term is called specified investment business income. So to receive specified investment business income in the corporation, you have to pay 50% tax, 50. So that's a lot. But whereas if for him specifically, because he doesn't report anything else, so his income tax rate is anywhere between 0% to like maybe 20% at max. Now in the corporation, although you pay 50%, but 30% is refundable over time. And so your net amount that you need to pay in the corporation is 20%.
Gotcha.
And then
so the second layer can affect you, where you actually end up benefiting if your income is low, to have it come directly to you.
Yeah, exactly. So you may as well just take that money out from the corporation, unless there
Love
are
it.
other reasons to set up the corporation, right? There are other reasons for it. If that person is super concerned about legal protection, then of course we would set it up. The guy that my client specifically wasn't concerned about legal protection at all. So then that was also the other reason why he didn't set up corporation.
I love this because you can actually see that it's definitely personal. It's definitely based on the circumstances. But I also appreciate that you have a kind of a summary, a way of looking at it at a very high level that I think will resonate with people, give them something to kind of chew on. But absolutely, everyone should be looking into this with more detail and with the right person. So great.
Yeah, absolutely. Now the next criteria typically is again, I guess I kind of covered it before, but the other factor is the number of properties that you're purchasing in relation to your own income. Now, what we have discovered, because I'm also a real estate investor, and there are a lot of real estate investors that we work with, what we recently discovered was, which is kind of silly, I just recently discovered it last year, is that if you buy properties directly inside a corporation and you purchase a property in the corporation name, it is harder to get financing and only certain lenders would work with you and all that. I 100% agree, but the mortgage is registered in the corporation's name. Now, what it means is that you still personally guarantee it. So
Yes.
then they still put something on your credit report. But the miracle, I guess the miracle or the loophole is that if it is not in your name, the guarantee doesn't count toward your future qualification
Yes.
if you buy in your personal name.
Yes.
So that's something that's interesting. Like for those people that are thinking of, hey, I need to buy like 10 properties. How do I do this? One way to do it is buy some properties in one corporation and buy some other properties in the other corporation. Even with the personal guarantee, the bank only look at your income. If you still want to use the income approach to qualify for more purchase with A lenders, that's another option.
Guys, if you missed that, go back and listen because you're right. That's a stroke of genius. And I see people going through corporations in order to avoid affecting their ability, especially with things like the stress test now. It's getting harder to qualify. So having these things, you feel like it's in a corporation, it still kind of counts. Not necessarily having them in separate corporations allows you to still qualify on your own. The other thing that recently happened, actually, I think it happened last year. I was talking to a top mortgage broker about it. He said, if you're purchasing through a corporation, the mortgage brokers, not banks, only mortgage brokers are not allowed to sell you a residential mortgage. It's only right now, they're only allowed to sell you a commercial mortgage if you're purchasing through a corporation, which was a shocker. Obviously benefits the banks, but something also to keep in mind in speaking to your ability to qualify.
I know it's so complicated, which makes it so much harder to advise client, hey, there's this option. If you want to buy more, you should set up a corporation. And then the next question, how do I qualify for financing the corporation? I'm like, well, you kind of have to knock on every single bank's doors instead of working with a specific mortgage broker, which is totally not right. But that's how it is. Like you could essentially, I don't know if I'm allowed to say that, but you could essentially go to Scotiabank at the branch level, which is really difficult to work with, by the way, and qualify using a corporation. But then the mortgage broker who's super experienced with investor would not be able to help you with the same bank. That's just how silly it is.
Yes. No, and that's a new thing that's come in. And I think it's completely unfair, but that's a new restriction that I only recently learned about. But that's something you need to consider. So I think a big part of it is you need to figure out where is that bottleneck for you, right? Like, and if the bottleneck happens at your personal primary residence, then well, then maybe we're looking at corporation. But if the bottleneck happens at the qualification for a mortgage, well, then maybe we're leaning towards putting it in our name personally. Fantastic. What else you got?
Well, one thing is that people often ask me how they would be able to transfer, or eventually one day their end game is to transfer some of the assets to their kids or leave the assets to the kids. And so depending on how long you're thinking of, if you are owning all your everything in your personal name, typically accountants would tell you, okay, you can do something called an estate freeze to transfer your assets that you own personally to your next generation. That's typically how it works. Now, in a typical estate freeze, essentially you freeze the value of the assets and then transfer it at $0 to your kids. At that point, when that happens, it typically involves a corporation. So you will sell all your assets to the corporation, and then you issue shares to your next generation, practically tax-free dollar. But the only downside is that when you do that, and if you were to own everything in your personal name, then you have to do the transfer to the corporation. And in Ontario, when you do any transfer from your personal name to the corporation's name, it triggers land transfer tax.
Yes.
It doesn't trigger capital gain. Yes.
And transfer tax. Yeah. That's a good point as well.
The land transfer tax is actually huge, and it's based on the fair market value at the time of the transfer. So if you heavily invest in Toronto, and we all know Toronto has double land transfer tax, if you heavily invest in Toronto, for example, I still own the home that I lived in as my primary residence back in the days before I met my husband, and that house, that's a Toronto townhouse, and I so wanted to transfer it to a corporation, but back then it was costing me $500,000 to buy, and nowadays it's over $1 million. For me to pay the cost of transfer, it's about $30,000, $26,000 to $30,000 off the top of my head. But that cost is hard to digest. I'm not even talking about capital gain, because there is a way to defer the capital gain, but there is no way to avoid the land transfer tax.
Gotcha.
And that's why it made a huge difference, especially for generational transfer.
Delaying the capital gains is new to me. I would have assumed that there would be capital gains. So I'm guessing there's probably, because it's an estate freeze exemptions, is that how that plays out?
It doesn't have to be under estate freeze, but typically when you sell a property to the corporation, you can choose to transfer it on a tax-free rollover basis. And then in exchange, the corporation essentially owes you whatever the capital gain would be.
Gotcha. And I don't want to take your last point, but one of the other things is for the saleability of corporations. I hope that's not your 7th point, is it?
No.
Okay, so this idea, I didn't want to step on your toes. This idea of being able to sell, again, avoiding the land transfer tax, shares in a corporation is significantly easier than selling off a portfolio of 10 properties.
Absolutely, that's one thing too, right? There's the next level. I don't really remember off the top of my head what my 7th point is, but going along with your suggested
perfect, we'll use that one. There you
point,
go. There's number 7.
I recently met some guy who does financial planning, and he is able to help someone with a large portfolio, real estate portfolio, make it securitize it, essentially make it kind of like a public company that you sell shares off to different people. You still have control, certain percentage of it. And that is something that is the next level, right? Like if you really want to grow to that point, you could essentially take your whole portfolio, securitize it, and sell a portion of it off. You still can own a piece of it. It's just not the entire piece.
Yeah, there's definitely a lot more flexibility in the corporation. One of the things I was going to ask you was about declared income versus affordability. People are struggling with affordability now for people, especially self-employed, right? You get all these deductions. Are we in a better position to have the income declared, or should we be just maybe leaning on, like, how, when you approach that? I know what my thoughts are, but I'm curious, what is your perspective? How do you plan for that for someone who's like, I have my own business, I'm self-employed, I'm looking to buy a property in a couple of years? What would you say to that individual?
It goes back to the amount. It goes back to the individual circumstances, to be honest. Like, for example, I work with a lot of realtors. They're all self-employed. In the past, being realtors means that you have to report all your income pretty much. There is no way to get around it. At the year end, your brokerage issue a T4A for you. So you report the income, you deduct the expenses. Majority of the clients are having trouble qualifying for financing and because they are self-employed, especially for the new realtors that come in, or new small business owners that just started their business and they have large amounts of cash sitting and they just cannot get mortgage. Now, there are a couple of ways to get around it. Essentially, I've also, well, one thing is to work with, if you're buying your own home, work with some banks that are happy to work with self-declared income. I just recently purchased my duplex investment, and I use Home Trust. And yes, interest rate is higher, but in a couple of years, because to qualify for financing as a self-employed individual, they look at 2 years of income average of it. So you have to suck it up for 2 years, essentially high interest for 2 years, and it's better than not buying. Now, the other angle to look at it is that I have a couple of small business owner client. They own their properties in the corporation's name, okay? And they own their businesses also in the corporation's name. So the business is then paying him money as a salary or dividend, and he could turn around and use that salary or dividend to qualify for financing. Or he could use his business income to qualify for financing. Now, then it would be different. Like, you're still paying yourself whatever you need. Personally, you don't pay more than you need just to qualify for financing.
Sure.
You can, but then the cost is the tax bill. People don't
but the strength of the
often
income of the corporation can be used too.
Yes, you could totally go to a bank or some mortgage broker would allow you to use your corporate income to qualify for financing. And sometimes they are commercial terms, sometimes they're not commercial terms, sometimes they're still really good. On top of that, there's something called private banking, or high net worth program, whatever they call it. Like, every bank call it slightly different.
This is the new program that just came out, right? That overcomes the stress test. They're starting to prioritize. I don't know if it's the same program you're talking about.
There are so many different banks with different programs, so I'm not sure.
But it's geared towards high net worth, similar to what you're saying. Yeah.
Yeah. So one of the programs, like, for example, I bought my own home, moved into it earlier this year, and I qualify under this program. They can only lend you up to 65% loan to value. Okay. And then I'm required to put in certain amount to be with that bank. So this was with CIBC. And then I also heard from Scotia that if you qualify under their high net worth program and you sign up with their private banking, they would be able to give you a 65% mortgage all across your assets. So it's not just one. So 65%, and it's only interest only. So you don't even need to make principal payment. And that 65% mortgage could also be borrowed against your stock portfolio.
Wow.
So, like, then I went back to my Scotia rep and I asked them if that's the case, if my TFSA would even qualify. And they said, no, yeah, your TFSA would also qualify. You can borrow against
even
your TFSA
if it's not with their bank, or it needs to be transferred to them.
Well, my guess is that you would have to. I haven't gone far enough into the process, but my guess is that you would have to. But RSP doesn't qualify, only TFSA.
I mean, guys, obviously Cherry's got a ton of information here, a lot of knowledge and expertise. We could probably go on and on about more advanced tax tips, but I think this has been a really good introduction for people that are kind of considering how to structure as they're starting to build their portfolio. I would love for people to be able to find you, because I know people are going to want to touch base with you. One of the things I was going to ask you is how to find a good accountant. Obviously, contacting you is a good idea, but is there any other ways that people can filter and identify a real estate investor-based accountant?
I think as a minimum, that person needs to be owning some properties.
Yeah.
The level of understanding would be completely different than the person who don't own any properties or who don't refinance and share the same value as you. So that is something that I would ask for sure. And then ask them how many real estate investors they work with.
I love it. Love it. Cherry, how can people find you on social media, or if they want to get a hold of you, follow some of the cool stuff you're doing?
So you can find me on realestatetextips.ca. That's my website. I have a weekly blog post that I share with everyone. If you sign up, you'll get my weekly tax tips. I also do own a YouTube channel, a Facebook page, and as well as Instagram. The handle is always Real Estate Tax Tips.
Awesome. Guys, Cherry's helps a lot of large investors in the GTA, and it's been an honor talking to you and being able to kind of introduce people to this topic. So guys, support the channel, hit the like button. If you have a comment or a question for myself or Cherry, you can. You can also tag us at Watson Estates on Instagram. Cherry, I appreciate your time, and we'll see you again soon.
Thank you, Bradley. Thanks.